In this video, I'll be sharing 3 stocks that should benefit big time from high oil prices, and hint, they're not oil and gas stocks. The surge in oil prices began a few weeks ago when Russia decided to invade Ukraine, causing insane geopolitical tensions, where many countries initiated sanctions against Russia in disagreement. However, since Russia is the 3rd largest producer of oil in the world, while they export about 8% of the global oil supply, any Russian oil supply cuts could cause a major disruption to the economy, and especially to Europe, which is heavily dependent on Russia's energy right now. As a result, WTI and Brent crude oil prices have recently skyrocketed to nearly $120 per barrel due to these supply concerns, which are the highest levels seen since 2008. And I just want to say my thoughts and prayers go out to everyone stuck in this awful situation over in the Ukraine and even in Russia who disagree with this whole situation. I truly think it's horrific, and it honestly makes me appreciate living in Canada so much more. But anyways, for those of us fortunate enough to invest right now, why not invest directly into oil and gas stocks to try and take advantage of this surge in oil prices? Well, let's take a quick look at the long-term history of oil prices. We can see over the past 25 years that oil has rarely reached the levels it's seeing today, and even when it did, the high prices only lasted shortly and were followed by a huge crash. That's because everyone starts increasing oil production like crazy to make money while oil is high, but then when demand eventually drops off, supply remains high and oil prices crash. Personally, I think investing in oil stocks heavily right now is quite risky, and I would much rather hold investments that can benefit from this current situation, but also be great investments over the long term. So in today's video, I'll be sharing 3 stocks that I believe fit both of these conditions. Just remember to drop a like for all of the work that went into this video today, and don't forget to subscribe if you have not already so you don't miss any of my future uploads. And by the way, if you want to learn more about investing alongside me and many other investors, you can join my Discord community of investors, where I also post all of my stock trades. We have an intrinsic value calculator, tons of great value like coaching calls, so you won't want to miss out. But anyways, with that said, let's get straight into the video. Now, the first stock that will likely benefit from high oil prices is ironically Tesla, with ticker symbol TSLA. One might think that investing in oil stocks would be a much better alternative to investing in Tesla stock right now, but I would tend to disagree. Just consider this for a minute. The higher the price of oil, the higher the cost it is to operate an internal combustion engine vehicle or an ICE vehicle. Therefore, one of the most surefire ways that someone can save money on fuel costs is to not buy the fuel at all and actually drive an EV instead, or an electric vehicle. Higher gas prices effectively make EVs more economically feasible for the average consumer. So I strongly believe that the current economic crisis between Russia and Ukraine causing these elevated oil prices is actually driving the transition towards EV adoption even faster. Just like the COVID crisis caused an acceleration towards e-commerce adoption and internet reliance much faster than it was expected. Plus, when oil prices eventually do crash, and I'm quite sure that they will within the next few years as EV adoption just takes off, the long-term prospects for Tesla will still remain strong, unlike those of many of the oil stocks that are booming right now in the short term. Now, if you follow Tesla at all, you'd already know that the company is supply and capacity constrained, not demand constrained. So how will this increased demand for EVs right now actually benefit Tesla? Well, if demand for EVs continues growing faster than Tesla can increase their supply to meet that demand, Tesla will be forced to raise prices to keep the wait times on their cars down. For example, right now, if you want to buy a Tesla Model S, you're looking at a delivery date in July, which is already a 5-month wait time. The same thing goes for the base Model 3, and even if you want to spend a little bit more money and buy the Model 3 long-range version, you'll still be waiting 3 months until May for a delivery. But what about the Model Y? I mean, that one's got to be more available, right? Well, actually, you'll be waiting until August or 6 months from now if you do want the base Model Y. So it just wouldn't make sense for Tesla to have wait times longer than 6 months if they can just simply increase prices to keep those wait times to a normal level. Therefore, I can see Tesla's margins and profitability only getting stronger as oil prices remain high. But again, even when oil prices drop, Tesla's EVs will still be in very high demand, even if they have to reduce prices a little bit. Now, in terms of the valuation, Tesla stock has come down significantly over the past year, with its forward PE ratio now being below 80. And although this still seems high, Tesla is growing revenues and earnings well above 50% per year, and analyst estimates are still incredibly bearish in my own opinion. So I think that Tesla stock is an incredible buy right now, and they should benefit in the short term from high oil prices, but also the long-term secular trends towards EV adoption. All right, now the second stock that will likely benefit from high oil prices right now is Enphase Energy, with ticker symbol ENPH. Enphase is another renewable energy tech company like Tesla that should benefit indirectly from the rise in oil prices due to its renewable energy technologies. They say founded in 2006, Enphase transformed the solar industry with our revolutionary microinverter technology, which turns sunlight into a safe, reliable, resilient, and scalable source of energy to power our lives. Today, our intelligent microinverters work with virtually every solar panel made, and when paired with our award-winning smart battery technology, we engineer one of the industry's best performing clean energy systems. So their microinverter technology works by allowing each solar panel in a home system to operate independently, providing constant and maximum power benefits to your home, as opposed to the legacy string inverter technology. And so far, Enphase has installed more than 42 million microinverters on approximately 1.9 million homes in over 130 countries. So if you do see a home with solar panels on it, there's a very good chance it's an Enphase home. So then how will Enphase benefit from these rising oil prices? Well, firstly, Enphase should directly benefit from the increased EV demand through their recent acquisition of Clipper Creek, one of the leading EV charging companies that provides charging distributors and installers worldwide. And secondly, with the rise in EV popularity, guess what else is going to become very popular? That's right, home and battery technology solutions, so people no longer have to pay for electricity and won't have to worry when a power outage occurs that they can't charge their EV. So growing EV adoption will increase demand for all kinds of renewable energy products, many of which are Enphase's specialty. Now, looking at their financial history, Enphase has had very solid revenue growth the past few years, aside from the hit they took during COVID. And in their recent earnings report, we can see that Enphase produced record revenue of $412.7 million, up 56% year over year, and they had a gross margin of about 40%, which is quite incredible for a hardware business. Next, Enphase produced non-GAAP diluted EPS of 73 cents, up from 51 cents last year, which represents EPS growth of 43%. I personally think these growth rates are incredible, and it definitely shows that the company deserves a higher valuation, especially considering the fact that they are going to benefit from this long-term secular trend towards EV adoption. So if we calculate their valuation based on full year 2021 non-GAAP diluted EPS of $2.41, we get a trailing PE ratio of 67 right now, which is high, but definitely expected for this type of growth. Enphase also issued some strong guidance, with revenues in Q1 2022 expected to be between $420 million and $440 million, representing quarter-over-quarter revenue growth. Finally, Enphase has $1 billion in cash and cash equivalents, which is over twice their current liabilities and about equal to their long-term debt. They also repurchased $300 million in common shares in December 2021 alone, so I love to see that management is very shareholder-focused and is focused on repurchasing shares rather than diluting. Anyways, Enphase is a very interesting renewable energy tech stock that I would love to get my hands on sooner than later, and considering that it is still down from all-time highs, it could be a pretty good buy. Obviously, the valuation is a little bit high, but they will benefit indirectly from these high oil prices. All right, now the third and last stock to benefit from rising oil prices is Brookfield Renewable Partners, with ticker symbol BEP on the New York Stock Exchange, or BEP-UN.TO on the TSX here in Canada. One of the biggest issues facing Europe right now is their reliance on oil and gas supply from Russia, which I explained has caused this huge spike in oil prices. However, one of the best ways to combat this reliance on Russia's oil is to invest heavily in renewable energy sources such as hydro, wind, and solar, which would allow Europe to become more independent in terms of energy generation. Luckily, these three categories are all Brookfield's specialties, and they are the global leader in renewable energy assets. In fact, BEP is also very well positioned in Europe, having over 500 gigawatts of installed power generation capacity to date. Therefore, Brookfield should benefit greatly in Europe with this increased renewable energy demand to come. And I forgot to mention, this should also benefit Tesla as well, because Tesla is in the energy business. They deploy energy storage as well as solar solutions. Furthermore, Brookfield should also indirectly benefit from the increased adoption of EVs, since a higher number of electric vehicles on the road means that there's going to be a higher need for electricity generation, and that is exactly where Brookfield specializes. So the current global situation actually benefits Brookfield Renewables twofold, in my opinion. As we can see from Brookfield's stock price today, the market is already recognizing this, with Brookfield stock up over 4% on a day when the S&P 500 is down over 2%. However, Brookfield is still down about 10% from all-time highs, which means there could still be an opportunity to buy the dip. However, let's first take a look at their financials before drawing any conclusions. So Brookfield reported Q4 2021 earnings on February 4th, where they reported record results and a 5% distribution increase, which is already a good sign. So BEP reported funds from operation of 33 cents per unit, up from 31 cents per unit in the prior year quarter, which only represents growth of about 6% year over year. But for the full year of 2021, BEP reported funds from operations per unit of $1.45, up from $1.32 last year, which is growth of about 10%. They also say their wind and solar segments generated a combined $581 million of FFO, representing a 55% increase in the prior year, where they benefited from contributions from acquisitions and approximately 770 megawatts of solar and wind projects commissioned during the year. So I love to see that their wind and solar segments are showing to be huge growth drivers for Brookfield. Now, if we divide their stock price of $39 per unit by their FFO per unit of $1.45 in 2021, we get a trailing price to FFO of 26.9 right now, which I'm not going to lie is a little bit expensive for the growth that Brookfield is seeing. However, when we look at Brookfield's business model, this is a very solid business model since they do have very long-term power purchase agreements from their existing renewable energy assets, which makes it a very safe company to own, and I believe this factor plays into their higher valuation. Finally, we can see that Brookfield is also very financially stable, having $4.1 billion of total available liquidity at the end of year 2021. So overall, with Brookfield being a pure play in the renewable energy industry, I think this is a great investment in both the short term and the long term because they will benefit from these high oil prices in terms of EV demand increasing, but also through clean power generation across Europe. Anyways, the three stocks that should benefit greatly from higher oil prices are Tesla, Enphase Energy, and Brookfield Renewables. So if you did enjoy the video, I really would appreciate a thumbs up since this did take a lot of time and effort to research. Also, please consider subscribing so you don't miss out on any of my future uploads. I plan on uploading tons more content coming soon, so stay tuned for that. But with that said, I will see you all in the next one.